Hello, good day. How do you determine a stock's true value? What drives a stock value? Many factors come into play, but what matters most is what investors believe about the company's future. The objectives of this learning session is to explain how to determine a stock's intrinsic value through company analysis. The methodology covered in this video include qualitative company analysis, financial statement analysis, present value approach, and relative valuation techniques. I used to be an investment analyst in a stockbroking firm during the early days of my career. I'm glad that the hands-on experience broadened my exposure and enables me to share my knowledge in a more practical way with you. Let's learn together. The objectives of this learning session is to explain how to determine a stock's intrinsic value through company analysis. This video describes the valuation methodologies commonly used by stock market analysts to uncover mispriced securities. At the end of this learning session, it is hoped that students will gain a basic appreciation of the procedures used in company analysis. Take note that this topic is highly relevant for your portfolio management assignment. I hope you can apply the concepts and techniques in your investment analysis project. In company analysis, analysts and investors seek answers to the following questions. Which are the best companies within the industry? What is the intrinsic value of the stock? Is the stock underpriced or overpriced? In my last few videos, we have examined several aspects of security analysis, including macroeconomic factors and industry factors. What is company analysis? Company analysis is the third step in top-down valuation approach. Company analysis takes a close look at the actual financial performance of the company. Such analysis is not meant simply to provide interesting information about how the company has performed in the past. Rather, company analysis is done to help investors formulate expectations about the future performance of the company and its stock. In stock valuation, it's not the past that is important, but the future. The value of stock is a function of its future return. Past performance provides no guarantees about future returns. Why are we looking at past performance then? Well, it can give us a good idea on a company's strengths and weaknesses. For example, it can tell us how well the company's products have done in the marketplace, how the company's fiscal health shapes up, and how management tends to respond to difficult situations. The past can reveal how well the company is positioned to take advantage of the things that may occur in the future. Therefore, the primary reason for looking at past performance is to gain insight about the future direction of the firm. It helps investors predict the future and determining how well the company is situated to meet the challenges that lie ahead. Make no mistake about it, in investments, it's the future that matters. How to conduct company analysis? There are three broad areas to cover in company analysis, which include qualitative analysis, financial statement and ratio analysis, as well as determining intrinsic value. We will learn about all the three areas more in details in the following slides. The qualitative analysis of company should occur in the context of the prevailing economic and industry conditions. Michael Porter suggests two major competitive strategies: low-cost leadership and differentiation. These two competitive strategies detect how a firm has decided to cope with the 5 competitive conditions that define an industry's environment. SWOT analysis involves an examination of a firm's strengths, weaknesses, opportunities, and threats. Strengths and weaknesses involve identifying the firm's internal abilities or lacking. Opportunities and threats consider external situations. You may refer to the examples in the table. The SWOT analysis helps investors to evaluate a firm's strategies and determine if a company has competitive advantages to defend against its weaknesses. Peter Lynch is a mutual fund manager of the Magellan Fund and Fidelity Investment between 1977 and 1990. Lynch averaged a 29.2% annual return, consistently more than doubling the S&P 500 stock market index and making it the best performing mutual fund in the world. This slide shows the key lessons from Peter Lynch about how to select good companies. First, the firm's product is not faddish. It is one that customers will continue to purchase over time. Second, the company has sustainable competitive advantage over its competitors. Third, the firm's industry or product has market stability. Therefore, it has little need to innovate or create product improvements or fear that it may lose technological advantage. Market stability means less potential for new entry or competition. Fourth, the firm can benefit from cost reductions. And lastly, the firm buys back its shares. When the management purchases the company's shares, it indicates that insiders are putting their money into the firm. Warren Buffett is the chairman and CEO of Berkshire Hathaway. He is considered as one of the most successful investors in the world, as well as one of the wealthiest persons in the world. Warren Buffett's investment tenets give good guidance about the key questions to ask in company analysis. For example, is the business simple and understandable? Is management rational? What is the intrinsic value of the business? Financial statement analysis is a vital part of company analysis. The major financial statements are the balance sheet, the income statement, and the statement of cash flows. The first two statements are essential for basic financial analysis because they contain data needed to compute many of the financial ratios. The statement of cash flows is used primarily to assess the cash or liquidity position of the firm. Financial statements present a numerical picture of a company's financial and operating health. Since each company is different, an analyst needs to examine the financial statements for industry characteristics as well as for differences between companies. Financial ratios are used to evaluate the financial condition, operating performance, and capital structure of the firm. Ratio analysis can be described as like a physical examination at the doctor's office. The results from ratio analysis can be compared with historical or industry standards. When using historical standards, investors compare the company's ratios from one year to the next. When using industry standards, investors compare a particular company's ratio to those of other companies in the same line of business. The reason we use ratio analysis is to develop information about the past that can be used to form expectations about the future. It is only from an understanding of a company's past performance that we can forecast its future with some degree of confidence. For example, even if sales have been expanding rapidly over the past few years, we must carefully assess the reasons for the growth. rather than naively assuming that past growth rate will continue into the future. Financial ratios can be divided into 5 groups: liquidity ratio, activity ratio, leverage ratio, profitability ratio, and market ratio. I will not go through the financial ratios in details in this video as this topic is covered in accounting module. However, I hope you can obtain the formula of financial ratios from various textbooks. Some financial database, such as Thomson Reuters Refinitiv and Osiris, provide financial ratios to the users directly. However, it is always a good habit to check and verify the calculation against the raw data. Let me ask you a question. Is the common stock of a good company a good investment? Well, not necessary. After analyzing a company and deriving an understanding of its strengths and weaknesses, analysts need to compute the intrinsic value of the common stock and compare this to its market value to determine if the company's stock should be purchased or sold. If the intrinsic value is higher than the market price, the stock is undervalued. Therefore, investors should buy the stock. If the intrinsic value is less than the market price, this means the stock is overvalued, and investors should sell the stock. How can we calculate the intrinsic value of a common stock? This slide gives an overview of the commonly used methodology. There are two general approaches to valuation. First, the present value of cash flows, and second, the relative valuation techniques. The present value of cash flow is a discounting methodology. We can discount dividends, free cash flow to equity, or free operating cash flow to the firm to find the intrinsic value of the stock. We can use three assumptions for the growth rate: the zero growth model, the constant growth model, and the variable growth model. The relative valuation technique consists of price to earning ratio, price to cash flow ratio, price to book value ratio, as well as price to sales ratios. The PE approach is a favorite of security analysts and is widely used in practice. It is relatively simple to use. Mathematically, the price-earning ratio is simply the price per share divided by earning per share. Given an estimated earning per share figure, you decide on a PE ratio that you feel is appropriate for the stock. Then you use the equation stock price equal forecasted earning per share times PE ratio to calculate the price. It is customary to use forecasted earning per share for next year, that is to use projected earnings 1 year forward. This is because investors buy stock not for their past earnings, but for their expected future earnings. Take note that price-earning ratios are often expressed in the financial press as historical numbers using today's price divided by the latest 12-month earnings. Financial press do not compute PE ratio based on expected earning per share. The intuition behind the PE ratio is simple. A PE ratio of 20 times means an investor buying at the current market price is paying $20 for $1 in earning per share. Similarly, when a PE ratio of 20 times is paid, the earnings yield or earning price ratio is 1 divided by 20, which is 5%. The PE ratio is a function of several variables, including the growth rate in earnings, the general state of the market, the amount of debt in a company's capital structure, the current and projected rate of inflation, as well as the level of dividends. A relative useful point for evaluating the PE ratio is the average market multiple. This is simply the average PE ratio of all the stocks in a given market index, like the S&P 500, Dow Jones Industrial Average, or KLCI. The average market multiple indicates the general state of the market. It gives us an idea about the overall valuation of the market. Second, we will learn about the price to cash flow approach. This measure has long been popular with investors because cash flow is felt to provide a more accurate picture of a company's earning power than net earnings. Many observers contend that a firm's cash flow is less subject to manipulation than its earning per share. When used in stock valuation, the procedure is almost identical to the PE approach. A price to cash flow ratio is combined with a projected cash flow per share to arrive at what the stock should be trading for. Some investors use cash flow from operating activities as obtained from the statement of cash flow. Others use free cash flow. The most popular with professional analysts is EBITDA, earnings before interest, taxes, depreciation, and amortization. EBITDA represents cash earnings to the extent that the major non-cash expenditures, such as depreciation and amortization, are added back to the operating earnings. The price-to-book value ratio shows the relationship between a stock's current price and its accounting net worth, where accounting book value is simply total assets minus total liabilities. Many investors judge whether a stock is expensive or not on the basis of its current market price relative to the accounting book value per share. Book value is a reasonable measure of value for firms that have consistent accounting practice. Take note that this approach can apply to firms with negative earnings or cash flow. Price-to-book value ratio is the market price of common stock divided by book value per share. It is common to find that stock prices exceed book value per share, with the price-to-book value ratios typically exceed 1. The price-to-sales ratio is a valuable tool when considering investment, especially growth stocks. Some companies, like high-tech startups, have little or negative earnings. The earnings are either unreliable or highly unpredictable. In these cases, valuation procedures based on earnings and even cash flows aren't much help. So, investors turn to sales for valuation. The price-to-sales ratio is equal to market price of common stock divided by sales per share. Many bargain hunting investors look for stock with PS ratio of 2 or less. These securities are felt to offer the most potential for future price appreciation. Especially attractive to these investors are very low PS ratio of 1 or less. For example, a price-to-sales ratio of 0.9. Think about it. With a PS ratio of 0.9, you can buy $1 in sales for only 90 cents. So long as the company isn't in a bankruptcy case, such low PS multiples may well be worth pursuing.
I hope you have learned something from this video. See you and goodbye.